Yo, what's going on, everyone? So in today's video, I'm just going to be going over just some points and topics of discussion on risk management. So risk management is basically the thing that's going to make or break your trading, right? Again, I think I've said this before in this Accelerator series, but risk management and psychology, right? Hold on. Risk management and psychology is the most important thing, right? Strategy is not as important as risk management and psychology. Okay? This is 90%. Strategy is 10%. Strategy is a dime a dozen, right? If you look at the chart and, you pick out a strategy here, there's going to be 30 different strategies that would have bought here. And one would have sold here, one would have sold here, it's a dime a dozen, right? Strategies, no secret strategy exists. Okay? Just remember that. No secret strategy exists. Everything is just based off of supply and demand in the market because the market is an auction. All right. And the most important thing that you need to pay attention to and learn and get the best that you possibly can at is risk management and psychology. Okay. So now let's get into some, just points about risk management and how to be a professional risk manager. So first off, trading is, 100% surrounded by risk, right? You cannot make money by buying right here at 42.20 and selling right here at 42.40 and make $1,000 in 6 minutes without there also being the possibility of losing 10 points and losing $500 in another 10 minutes, right? Where instead of, you buy here and it goes up, you buy here and it goes down, right? Trading is a risky business, okay? You're going to have risk. There's a reason why people that don't know how to manage risk gamble everything away. And there's a reason why people that don't really have too much of an idea what trading actually is call it gambling. And they're 110% right. I mean, to a degree, it is gambling. But if you have an edge and you manage your risk, at that point, it's just a formula, right? So trading is totally surrounded by risk, and you just have to accept the fact that it's going to be risky, right? You're not going to know what is going to happen at all times, and you have to be okay with that. Right? The market's going here and here and here, and now it's trading here. Yeah, it might look obvious in hindsight that, we keep going up, but there's also the possibility that this was the top, and now we just fall off the face of the planet, and you get stopped out and try to buy here, and you get stopped out again. Okay, you have to be okay with all of that and with losing multiple trades in a row. So, first of all, let's talk about why trading, might be looked at as gambling. So first of all, if you are just randomly, waking up, not even knowing what's going on, just, ES is going up, I'm going to buy right here and see if I can, make some money, capture some points, that is 100% gambling. There's no setup. You didn't even come close to defining your risk. There is nothing to be trading there. You are gambling. Okay? 100% gambling. If you dump all of your money, if you can trade 3 contracts and you go in 3 contracts with no stop loss, no idea of when you're going to get out, no idea of where price should go, what price should be doing, that is also gambling. If you hold on to losing trades, that is gambling. If you are risking more than you make, that is gambling, right? If your risk to reward ratio is not at least 2 to 1, and it's actually 1 to 3, so for every $1,000 that you make, you're risking 3,000, then yeah, you're not going to be making money over the long term. That is also gambling. So the main points of why trading is gambling and why this is what you do not want to do is that if you're going in with no plan, with no stop loss, going in with massive position sizes, not, sizing down a little bit to a more manageable, smaller amount of the possible position that you could take. Okay, if you don't cut bad trades early and be really, really tight on, getting stopped out and just managing your risk, not being in bad trades. All of that is gambling. Do not do that. However, if you come into the market with a plan, right? Where I'm going to enter, where I'm going to exit, where my take profit is going to be, what is my risk to reward ratio going to be on this trade? How many contracts am I going to go in with? Right? All of that kind of stuff. Having a plan. That is using risk management. Knowing when to get out of the trade. Right? Not buying at 42.20. It goes to 42.10. You were supposed to get out at 42.15. It's at 42.10. And you're still not getting out. It's now down at 42.05 and you're still not getting out. It's at 4,200 and you're still not getting out. Don't do that stuff, okay? A good risk managing trader gets in, identifies a trade setup at 42.20, stop loss 42.15, target 42.30, 42.40. If it goes to 42.15, boom, out, done. There's nothing more that is said about this trade. It's invalidated. It's done. Right? If it hits 42.30 and goes to 42.40, they're out. They're not gonna keep holding and see if it can keep going up and then it just crashes and none of that. Right? They follow their plan. They go in. If they could take 4 contracts, they only go in with 1. A professional risk managing trader focuses on little base hits, right? 200, 300, minus 100, 300, 400, minus 150, right? All of this, right, whatever that would be, is infinitely better than 700 minus 600, 800 minus 1,300 plus 1,500. While yes, a gambling mindset trader might look at, oh, but he made more. He made 700. He made 1,500. He made 800, right? I don't know what this adds up to. Let's say it's even more, right? Let's say it's still $1,000 more than, the more consistent but smaller profits. Okay, but this is also totally unsustainable. Because look, the losses got bigger. And there's no real strategy or risk management here. Right? This is a small loss. Right? This is a 2 to 1 risk to reward ratio. 200, risking $100 to make 200. Perfect. Risking 1,300 to make 700. That's a 1 to 2 risk to reward ratio. That is going to be completely unprofitable over time. You would have to have an insanely high win rate to compensate for a garbage non-1-to-1 risk to reward ratio. So the first step in my 4-step plan risk management process is, first of all, identify risk. you need to know, first of all, how much money are you even going to be risking on this particular trade, right? It could vary. If you're using a 5-point stop loss or an 8-point stop loss, that's going to vary. You need to make sure that you're not over risking and, just going in with way too much money and not following a strict risk management plan. So first of all, identify your risk. How much money are you going to be risking? $100, $200, whatever it is, just figure that out. So let's say in this scenario, that is $100. The second step is figure out your risk to reward ratio, right? So if you don't know what a risk to reward ratio is, it's basically just, let's say that I longed ES at 42.20, take profit 42.30, stop loss 42.15. Whatever the distance is for my take profit, 42.20 to 42.30, that's 10 points. And my stop loss is 5. Divide your take profit by your stop loss. So 10 divided by 5. So that would be 2. So you're risking 2. So you're risking 1 point to every 2 points of potential gain, right? And a 2-to-1 risk to reward ratio is the minimum that you would want. So let's just say in this scenario, 2 to 1. So again, you're risking 1 point for every 2 points that you would want to be making. Now, the third step is position sizing. So you need to find out how many contracts that you are going to be going into the trade with. So if I want to risk $100 on, let's say, a 5-point stop loss, well, I would need to be trading micros, and if every point is worth $5 on a micro, so let's figure this out. So really quick here. So 100 divided by 100 divided by 5, right? So 100 divided by 5 equals 20. So 20 is now how much we will be risking per point, and obviously 5 points, so $20 per point, and then divide that by, in this case, it's pretty easy. Divide that by 5 again, and now that equals 4. So 4 micro ES contracts at a 5-point risk will now equal $100 of risk, right? Let's check that again. So 4 contracts times $5 per point equals $20 of risk per point. We're risking 5 points in this scenario. So that equals 100. Splendid. We can just leave that there, I guess. So boom, position sizing. So 4 micros. And now keep in mind, it's just going to depend on what your account size is. I will say it is very, very easy. It's a lot simpler if you keep your account size just static. Sure, you can compound, go from 10,000 to 12,000 to 14,000, but you're not going to be just increasing your position size exactly, per $1,000 or whatever that you put into your account, right? So if you just keep it at, let's say, 10,000, then you'll know that your risk or your position size will be pretty much one contract, one E-mini contract on 5 to 8 points, and you can keep it pretty, just consistent and easy. You don't have to do a bunch of math. This is all just when you're beginning, and once you find all this out, it'll be basically on every trade setup. So it'll be a lot quicker, and you won't have to do all of this math. But the math is obviously very, very simple. Now, the last point in my 4-step risk management plan is to manage your risk, right? And what does that mean? So when you are in the trade, right? You want to obviously, again, have your static stop loss, but you want to make sure that, you're managing your risk. So if price starts to go against you and it's at 3.5 points against you, 4 points, 4.5, yes, it will suck. Okay, because you could just bump up your stop loss from 5 to 4.5. But what if you did that in, or just a rash decision, and that was, the peak, and you got stopped out here, but your stop loss was actually right here, and if you just left it, and now it would have reversed fully, and you wouldn't have gotten stopped out because you moved it. So don't be fiddling around with your stop loss. Yes, it will suck. There are going to be some trades that if you just moved it down another point, you would have been good. But there's also other trades that, you keep moving it up and you just get crushed. And that's how you get destroyed. That's when trading becomes gambling, because, it only takes one trade to completely blow up your account and for you to just go on a full tilt. So make sure that you're just managing your risk, not doing anything crazy, just being cool, level-headed, and just trading well. And so, yeah, that is pretty much all I have in the risk management video for today. Of course, I am going to be making more videos on risk management in the future. Just today, I want to keep it simple, not every single thing that I have. This is just what you need to know right now so that you can start and begin and, trade live and start, doing this stuff live, gathering data, creating your journal, working on your psychology. And then if you need another video, you can either come back to this one, or in the future when I wrap up this series, I'll have more on just various topics. And you can go on one of those and click on one of my risk management videos and, learn from there. And I'll have a bunch of other stuff. So I hope you guys enjoyed watching this video. Hope you guys, thought that this was very, very valuable. Thank you for watching, and see you guys in the next one. Peace.